Hey everybody, welcome to this episode of Finance This, Property That. It is designed to educate and empower financial legacies for generations. We provide you with education from both my experience in the field of finance and property, and we bring in guest speakers who are experts in their sector of the finance and property fields. Hey everybody, welcome to this episode today. So really want to talk about a couple of things that are pertinent in lending. So having a look at your current situation. Is your investment portfolio a well-oiled machine, or is it a ticking time bomb? Today, what I'm going to talk about is around the investment portfolio and the structuring. Trust me, it sounds drier than a week-old sandwich, but it's really, really crucial that we actually get this right in order to build your financial legacy over generations, right? So why is structuring your portfolio so important? Well, imagine this. You're building a house, right? You're not going to start by picking the curtains first. You're going to need to have a solid foundation before building up. The same goes for your investments and your and your lending and finance. So without the right structures, what you might find yourself hitting is some serious roadblocks as you grow your wealth and grow your portfolio. So what happens if you don't structure your investments properly? Cool. Good question. Think of it this way. You are buying a property in your personal name for too long. It's kind of like trying to squeeze your family of four into a two-seater car. Right? Eventually, you're going to run out of space and you're just going to pop out the sides. Or in financial terms, you're going to hit serviceability barriers. On the flip side, you are jumping into trust structures way too early. That's probably going to hinder your cash flow, and it'll probably mean that you can't, take holidays and things like that. And you won't be able to also claim a few benefits that you can in your personal name. So, as the old saying goes, if you fail to plan, you plan to fail. Without a clear investment strategy, you might end up having a mismatch and inefficient portfolio that stops you from growing generational wealth. So, do you actually feel like your investment strategies are all over the place? All right, so never mind. Let's break stuff down for you, right? I'm going to just go through the pros and cons of all the different ways you can have lending. So the three different structures. So let's get into it. The most common way of purchasing, and everyone does it at least once, is purchasing in your personal name, right? Pretty simple. It's the simplest form. There are a few pros and there are a few cons. Let's go through the pros. Really, really simple. You're in your investment portfolio, if you're purchasing in your name, in most cases, you can claim your negative gearing, which means the losses on your property can offset the income that you earned, right? Which means that overall, your taxable income is less, which means that you pay less tax, which in some cases, you may get a tax refund. Also, when you sell that investment property, you can have potentially a capital gains discount. What capital gains is, say you purchased a property for $500,000 when you go to sell it, it's $600,000, you've made a capital gain of $100,000. Your accountant should be able to help you out with working out what your capital gains tax and how you can get discounts off that as well. So what are the cons? Well, as I said before, the cons around your serviceability be very limited, meaning the bank will eventually not lend you the money that you require because you simply can't service the debts that you currently have because you have outgrown that structure. The next structure, and I'm seeing more and more of this at the moment, is around trust. They like the Swiss Army knife of investment structures, right? There's so many ways you can cut it. There are pros and there are cons, okay? And before going into something like this, I encourage you with any sort of lending is to seek the advice from a professional like an accountant or a financial advisor, or even to a certain extent, a mortgage broker like myself. I can't advise you whether this is the best structure or not for tax, but I can advise you whether these structures are the best for servicing. All right, so the pros of a trust. Well, it maintains serviceability because the loans aren't actually in your name. Okay, what that means is you still have to be able to service your personal income, your personal liabilities, i.e. the home loans or loans in your name or credit cards in your name. But the trust isn't in your name. So when we go to borrow the next time, certain banks won't include the trust lending because hopefully it should be taking care of itself. We get an accountant's letter to cover that off in most cases. Again, it's a case-by-case scenario. They also offer great protection for your assets and potential creditors as well. Again, to understand more, speak to your accountant and financial advisor on how that happens. But here are the cons, right? There is no negative gearing, so it actually decreases your serviceability because you can't claim any of the interest back as to help with servicing. And most of the banks don't allow you to do that. There are some banks that will in certain situations. Again, speak to someone like myself who understands the policies around that. There's also no capital gains discount, okay? So you can't get that. You get whacked with the full capital gains. The biggest thing that I've seen that people do, though, is you've over-leveraged in your personal name. And if you want to transfer this property, let's say property B, which is an investment property, into your trust, well, you'll actually have to pay the stamp duty again. There is no getting out around that because you're basically selling the property in your name to the trust. And that's going to hurt, right? That's going to hurt the cash flow potentially. However, you may have made a bit of growth in that property as well. So again, speak to an accountant whether that's the best move for you. All right, the last one. And this is a really, really popular vehicle, as we call them right now. And that is called a self-managed super fund, or SMSF. So pros and cons. There are a few pros and there are a few cons, right? It is a very heavily regulated product. You'll find a lot of the banks, the major banks, have actually gone away from writing these, but there are actually some great financiers that will actually write these. I'm doing a lot at the moment. So what are the pros? You actually have better control over your assets, right? That's the biggest thing. It's non-recourse lending. So the property and the debt, the property doesn't actually sit in your, it's not owned by your super fund, it's owned by a bear trust. Now we can get into the complexities of that, but again, come see me and we can have a chat if that's the best move. Again, also in conjunction with your accountant and financial planner to ensure that this is the best move for you. The cons though, here they are. It's not like traditional lending. So lending in your name and personal name, you can actually realize the capital gain in your property. So if you bought the property for 500 and now the property's worth 800 in a personal name or trust, you can apply to pull the equity out, purchase another property. However, in an SMSF, you can't do that, right? This then now limits the ability to grow your portfolio inside the SMSF because basically you're going to pay that down and it becomes income that gets put into the accumulation fund, right? The other thing is sometimes the startup costs can be higher than a giraffe's eyebrows. So you got to make sure that you're getting the right advice. But if you're going into this, go into it with an open mind. Like it does diversify. It also frees up your serviceability outside of super as well. So you're building an asset over a long time and a long period, which actually will then help you towards your retirement. Again, get the advice from a financial planner. If you're going to do a self-managed super fund and you want to purchase property inside it, I would highly recommend getting the advice to make sure it's the right move for you. Make sure your accountants across self-managed super funds, setting up the self-managed super fund, trust and trustee, as well as the bear trust and bear trustee to purchase the actual property. So there you have it. right? All the ways you can set up your financial portfolio. Personal name, trust, self-managed super fund. As always, guys, to set up the winning approach, you need to have that team behind you. Speak to someone like myself who can help you with the potential debt structure and servicing, an accountant that can help you with the taxation and planning side of things, and a financial planner who can guide you through that long-term investment. I have a lot of these types of services on my trusted advisor list, so happy to share those with you. And as always, the information on this podcast is very general in nature, doesn't take into consideration your personal circumstances. Please seek guidance and advice from a professional in the field. Thank you again for joining me, and I'll see you guys on the next episode.